Welcome back, everyone. My name is Becky Lester, and I'm one of the faculty here at Stanford. And welcome back to the second session of the RAST conference today. It's my pleasure to moderate this session. So before doing so, again, I want to thank the RAST editors for giving me the opportunity to moderate, and also for organizing the conference along with Maureen McNichols and our conference team here at Stanford. I also want to thank Douglas Laporte, who is going to be helping me behind the scenes to compile, accept, and to read through all of your questions during this session. Douglas is one of our outstanding third-year PhD, he is our outstanding third-year PhD student that we have here in the group. So the format will be the same. We're going to have 15 minutes of a presentation by Charles Hadlock, and then we're going to have a 15-minute discussion by Ilia Dichev from Emory, and then 15 minutes for questions. Please be sure to use the Google form in chat to submit all questions, and then we'll be combining questions if we can to increase the number of questions we can get through during the session. With that, I will turn it over. I will break in and give you a heads up about 3 minutes before the end of your talk, and then if you go over, I'll break in at that point as well. So with that, I'll turn it over to Charles here for the session.
Great, thank you very much. It's great to be here. My name's Charlie Hadlock, and we have three, me and my author team here, we're all finance people. So this accounting stuff's a little bit new to us. So forgive us if we say a few things wrong, but we're going to try to look like we know a little bit of accounting. So this is joint work with Billy Greiser and Josh Pierce, who are both PhD students of mine many years ago. In fact, Josh was an undergrad of mine many years ago. Without further ado, let me tell you what we did in this paper. Let's see if I can get my technology. Okay, so first observation, which was news to us, but maybe not to the other 400 or 500 people out there, is that managers seem to care a lot about earnings. Okay, and we've never thought a lot about earnings because we're more in the finance world, obviously earnings are very important in terms of the information they convey to investors. And firms can make a lot of choices. We heard that in the previous paper, both accounting choices and real choices to manage their earnings. And I guess there's a lot of evidence out there that this does occur. And a lot of it takes, at least from our perspective, an ex post or a conditional perspective, meaning you look at firms that just had positive earnings or just meet analyst expectations. And then you go back and try to figure out, hey, did they do something to get them sort of over the hurdle? And so there's a lot of evidence on that, but we thought it would be useful and informative to try to do an unconditional analysis, to ask in a larger population of firms where we're not just finding folks that might have done this and figuring out how they did it, asking for a general population of firms, does it look like we can find some evidence of earnings management? And in this case, we think a dimension of real earnings management. And so to do that, you need to basically find some sort of event, or the strategy we had was to find an event where something should influence earnings if they're unmanaged, and then look at whether it influences earnings if actually reported earnings don't vary as much, or maybe aren't at all sensitive to something they should be sensitive to, as sort of more, and then try to figure out how they actually manage that. And so that's what we do here. And what we do is we basically identify some exogenous variation in firms' demand in the form of weather shocks, which there's been a pretty growing recent finance literature looking at these weather shocks. And so that's what we're going to exploit here. Okay, and we're going to look at this in the context of the utility industry. It turns out utilities, firm sales are very highly dependent on weather, and weather is largely random. I mean, there's some trends that we'll take out because of global warming, but there's a lot of random shocks. There's good and bad years in terms of energy demand based on the weather. You've got an industry that's highly capital intensive. You get these demand shocks. So you'd expect both sales to be sensitive to weather, which they will be, and we'll show you that. And then you'd also expect unmanaged earnings to be sensitive to weather, particularly if you have a lot of fixed costs. But certainly managers may try to smooth that out, and that would diminish the relationship. Okay, and so what we're going to do is we're going to start off looking at sales sensitivity to top line sensitivity to weather. Then we'll go down to the bottom line and see if sort of that relationship weakens, which it does. And then we're going to ask, well, what are they actually doing? Can we find some direct evidence of how they're smoothing earnings? And ideally, you'd want something that's sort of a discretionary item, that's late in the year, that's flexible, that's expensed from an accounting perspective and maybe hard for outsiders to easily detect. And so we're going to look at that in the context of charitable giving. Okay. Now, I've got to be honest. We had a sample of one to start with, and then I gave an executive ed lecture to one of the two large public utilities in Michigan, CMS Energy, Consumers Energy. They're a $12 billion utility. And the one day when I went to give my lecture, one of these lectures, I've been doing a lot of training, the usual nice spread they had for breakfast was not there. And I said, what happened to the nice Danish and the fancy coffee? And they said, well, we've had a warm winter, so we haven't sold as much electricity and gas as usual. And we've got to make our earnings numbers because we always have 7% growth. And so, we'll give you a cup of coffee if you don't tell the audience that we're giving it to you. And it actually wasn't very good coffee. But anyway, here is actually a picture from Consumers Energy's annual report a couple of years ago, its 10K statement. And you can see basically they point out that how much they're affected by the weather. A hot summer means you sell a lot of electricity. A mild winter means you don't. And so they basically talk about how the weather impacted them and then how they basically managed to get to a nice even 7% earnings growth. Okay. And so the question is, how common is this? We sort of found it interesting. And it's not just a Michigan phenomenon, because the CEO of this firm actually just recently became the CEO within the last month of, she's jumping to Pacific Gas and Electric. So I think that's the utility that's going to affect you folks out there at Stanford. Okay, so what do we do here? We basically put together a large sample of utilities, or the largest sample we can. We show that sales are in fact highly sensitive to weather. Okay, and then we go down the income statement, although it turns out we don't have to go very far down. Once we start even looking at EBITDA, and we thought we'd have to go further down, the sensitivity to weather largely goes away. And by the time you get down to net income, there's sort of nothing there. And so something's going on in terms of a firm's costs that looks like they could be managing earnings. But of course, this is indirect evidence. And so then to get direct evidence, we're going to go and hand collect data on charitable giving. Now, we tried some other things. We were hoping to get, anecdotally, a lot of these firms cancel things like executive ed, employee training, the Danish that I didn't get the day I was there doing a training session. It's hard to get data on that, but the charitable giving data is available with a lot of legwork. And so we go and get that data, and we find that firms basically seem to be varying their spending on that dimension, on that real dimension, in a way that would aid in earnings management, meaning when they get a positive demand shock and earnings would be high, they tend to ratchet up that spending much more than economic fundamentals would predict. And when the weather is unfavorable to sort of make their earnings numbers, it looks like, or at least to smooth their earnings, it looks like they're in fact giving less to charity. By the way, the Consumers Energy folks did tell me that they, in fact, their donation to the United Way at the end of the year very much sort of depends on the weather. Okay. We then try to do some comparative statics to see if this behavior is higher in certain environments where you might expect earnings management incentives to be larger. The evidence there is a little bit weak. The sample's pretty small, so I think we've got some power issues, but we certainly give it the college try, and we are more than open to suggestions from a group like this who knows maybe some other strategies to do this. And so we're going to show that they looks like they're managing their charitable spending in a way that's very consistent with smoothing earnings. The magnitudes of this effect are not, I mean, they're huge in terms of the percentage change of charitable spending, but it's not the biggest items, obviously, that firms spend on, but we think it's sort of the tip of the iceberg in terms of a lot of other activities like this that we don't have data on. And so the consequences of this could be fairly substantial. And we give a little bit of a comment on why we think that's the case. Okay, so there's this big literature on earnings management. Many folks in the virtual room here have been our participants in. And this, we're learning it. It's a lot of fun, actually. There is a nascent literature on charitable giving and ESG investments more generally. There's a debate there on whether sort of this giving is optimal or not. Some folks think it's an indication of agency problems. Others think it's actually efficient. More giving is sort of better, or more of these types of investments. As long as there's some sort of objective function that's being maximized by the managers, on the margin, we're really just going to test whether there's sort of a deviation from the optimal path depends somewhat on weather in a way that's consistent with earnings management concerns. And then this weather as an exogenous shock has been exploited quite a bit recently by finance authors. Utilities play a big role in this literature because utilities are very weather sensitive. And in fact, there was a very well-known paper in the Journal of Finance a few years ago that looks at the weather's derivatives market, which allows utilities to smooth out their cash flows. And it looks like it's causally associated with higher value. And I'll comment on that at the end. Okay. And there is one paper in the accounting literature, Petrovitz, 2006, that directly looks at charitable giving and finds evidence that it is used to sort of make earnings numbers. So that's in the context of finding firms that just made it over a certain threshold and then going back and looking at whether it looks like they might have manipulated what they were giving to make certain numbers. Okay, so we go through, do the standard thing. We get all the CompuStat data. We measure the weather in the total degree days. That's sort of a standard way of measuring how many days where you were selling a lot of electricity because it was above 65 degrees, or selling a lot of electricity and gas because it was below 65. Those are called heating and cooling days. We add them together. We get charitable data, largely hand collected from some IRS filings, the National Directory of Corporate Giving. And we're very careful for each firm, since we're looking at sort of the time trend or the time variation in a given firm's spending, to make sure for wherever we get it for a specific firm, we sort of follow it consistently over time. Final sample's got 51 firms, 340 firm years. We had hoped for more, but it turns out that it's really the bigger utilities like Consumers Energy, Pacific Gas and Electric, et cetera, that tend to be the ones that are giving a lot. Okay, we get a sample just to give you an idea of how big the charitable spending is. The mean number is about 5.5 million. The median's about 1 million, a little less than 1 million. These are as a percent of income, 1% at the mean, 0.23%. So these are small numbers, but not totally trivial numbers. Again, we really think it's more of a lens into these types of spending activities. So the first thing we do is we regress the income statement items, sales, EBITDA, and net income against weather. Okay, and so in the interest of time, I'm just going to plow right through. So bottom line is the units are hard to figure out because the right-hand side variable is sort of total degree days. But basically, weather does affect sales a ton, and it's highly significant. No surprise, that's what we expected. That's sort of well known in the industry. Now, we thought we'd have to sort of dig down, and as we went further down the income statement, and we only kind of barely know what an income statement, all the different parts are, because we're finance guys, that as you went further and further down, you'd find more and more sort of earnings management, more sort of noise in the system, so that eventually it wouldn't become weather sensitive. But it turns out when you just go to the EBITDA line, all of a sudden the weather result sort of goes away. So they somehow, between going from sales to EBITDA, there is no weather sensitivity whatsoever. And when you get to net income, even less so. Okay, I know I've got about 3 minutes left. I hear somebody.
Exactly, yep, right on 3 minutes.
Okay, so the bottom line is a 1 quartile change in weather ends up in about a 6% change in sales, no relationship with EBITDA. So then the question is, could it be that they're in fact doing can we find some real evidence of changing some of the spending in a way that when weather is going against you and your earnings would go down, you're skimping on things like your charitable giving, and vice versa when weather's going with you. And so here's the bottom line. Here's the regression of charitable giving against these weather shocks. And the bottom line is we get very large effects. We get very large elasticities where a 1% change in weather ends up roughly translating into about a 4 or 5% change in charitable giving. Highly significant. There's a lot of different types of ways to model this, whether you do changes, logarithms, percents. We get basically a very big, large economic magnitude effects where it looks like there's extreme sensitivity of how much these utilities give to what's going on in cash with what's going on with the weather. Okay, so this is not, freebies in terms of free electricity or something like that. Okay, so now one explanation is we originally thought this was going to be a finance paper about financial constraints, but it turns out you can't really take seriously the idea these are financially constrained firms because they're very large, they have good bond ratings, they have good debt market access, but we do, in fact, split the sample by various measures, finance measures of financial constraints, and there is no difference in the sensitivity of this charitable giving to weather depending on financial constraints. it's been suggested to us that maybe the optimal degree of giving does in fact depend on the weather. We originally just said, hey, that doesn't make any sense. Just like the optimal amount of Danish to give me when I'm giving a lecture at a corporate headquarters probably doesn't depend on the weather. But you maybe could make a case. We don't know a lot about sort of the optimal charitable giving. We don't have a great theory of that. We've sort of looked into it. So our basic argument here is A, the magnitudes are too large to really square with any reasonable technological description of sort of an optimal path of charitable giving with respect to weather, independent of earnings management concerns. But then also to actually subject that to some empirical evidence, we look at the relationship between charitable giving and Tobin's Q, because Q is known as a big determinant of an investment in general. Some of the prior literature on charitable giving has looked at the sensitivity of giving to Q and finds a sensitivity. And whether we use our data or prior authors' data, the kind of magnitudes we're getting would suggest that weather is 100 times more important than Q as a determinant of charitable giving. So it looks like it's much, and Q we would think would be a proxy for economic fundamentals. So we don't think that we're just uncovering the optimal amount to give is related to the weather. Okay, we try to do some comparative statics. The only thing that works a little bit is we sort of argue, if the weather kills you or is really good or bad in the fourth quarter, you got less time to react. And so you might see a bigger sensitivity to fourth quarter weather versus Q1 through Q3, at least with respect to charitable giving. A lot of firms wait till the end of the year to make that choice, so sort of their last piggy bank, if you will. And we find some evidence along those lines. We also separate by managerial ownership and institutional ownership. I know that's been done before in some of the accounting literature. We get mixed evidence there. Okay, so to conclude, utilities have sales that are very sensitive to exogenous weather variation. We don't have a lot of controls in these models because our right-hand side variable is uncorrelated with everything. So we don't need to control for other stuff and worry about all kinds of messy endogeneity problems. As you move down the income statement, the sensitivity quickly disappears. It's certainly consistent with earnings management in its many forms, real or non-real. But then to sort of go and look at what's going on behind the scenes, we find that charitable giving is very sensitive to the weather. The magnitude of the effect suggests that it's not just reflecting financial constraints or sort of optimal giving policy independent of earnings management. So we think that's what's going on, but we're open to any and all suggestions. And lastly, let me just conclude with this. It's not clear what the welfare effects of this are, but the fact that this journal finance paper shows that utilities value goes up when they can hedge weather risk, even though they're not financially constrained, is consistent with the idea that when they can hedge this risk, they won't play these wasteful games like real earnings management, and that is then impounded into the stock price. So it's sort of food for future thought. And with that, I will end. Thank you.
So thank you for the opportunity to present. Hi, everyone. It looks like a big conference. So it's a discussion of this paper. I would like to start with a brief introduction just to position the paper in the broader literature on earnings management. So this is one of the oldest, most developed strands of the academic accounting research, as well known. And I think when you look at the entire literature, basically there's little doubt that earnings management exists. And we know that from a nice triangulation from a bunch of archival studies, but also surveys of managers and financial analysts, and also SEC actions and legal actions. So all of this leaves little doubt that it exists, but there are more debates about the prevalence, magnitude, methods, and consequence of earnings management. And this partly, to a large extent, actually depends on how do you define earnings management. So basically, the more mild forms of earnings management are quite widespread, maybe 10-20% of the populations. And the more extreme forms, which violate GAAP and venture into fraud, these are much low percentages, maybe on the magnitude of 1-2%. Right. So given this long-standing line of work, it's become harder to make a sizable contribution to this literature, and particularly it's become harder to just run some kind of large sample regression on a model like the Jones model, and this might not be enough these days. So I think this is where the paper, one of the places where the paper shines here, it's a more focused setting, which allows some more precise analysis. I would say on a taste level, the single biggest problem in this literature and the single biggest challenge for those who do work in this area is that the correct specification of the null hypothesis. Null hypothesis here is, how would the earnings look like if there was no earnings management? And this is surprisingly tough because we don't know, right? Bottom line here is, if you have a good expectation about the null, if the null is sharply defined, you have a powerful test and you have good evidence. And otherwise, things are messy, right? For example, if companies are not doing well, they're cutting R&D and they make their numbers. Did they cut R&D to make the numbers, or do they cut R&D because business is not good? It's very hard to distinguish between these things. All right, so what's going on here in this paper? A highlight is the focus setting, right? It's a small sample which allows some more precise work, and I'll talk about this in a moment. Although the paper doesn't put it this way, to me, essentially the story is about the null changes, and the way I put it here is, the null hypothesis basically is that revenue and earnings of utility firms will be highly sensitive to exogenous weather shocks, right? And the alternative is that, well, but if they smooth earnings, revenue will be sensitive, but not earnings, okay? And so when you look at this, my first reaction is, I like it, this is neat, right? That the weather variation is a neat variable. So basically, the paper has good bones. That's how we say it sometimes. Note also that one can make a reasonable argument that in the presence of high fixed costs, and these are utilities, earnings should be even more sensitive than revenues, right? So in that sense, this gives some heft to the paper. All right, so skipping directly to the findings, because I did like what the authors did with the methodology. As usual, there could be some quibbles there, but overall, I think tests were reasonable given the context and skillful. And so I'm not going to spend much time on that. I'll discuss the findings. So the first main finding is that revenue is quite sensitive to weather shocks. This is what Charlie was just showing. And that makes a lot of sense, right? When I look at my utility bill, when it's cold, it's higher, right? So roughly speaking, all right, I have this automatic lights here, sorry, but that's what it is. I don't control that. So roughly speaking, I think Charlie mentioned this approximately 1/4 increase leads to a change of revenue of 6%. Okay, just for a feel of the economic magnitudes which are involved here. But EBITDA and net income are not sensitive to weather shock. This is the other side of this main finding. And the authors attribute this to earnings management. So my take on it, the earnings management explanation is definitely plausible. But for my taste, at least, the evidence so far is indirect, it's circumstantial. So I think maybe more work is needed here to clinch the case. Specifically, what could be done here? Basically, you have to work on the two sides of the hypothesis. The first challenge is to disprove null explanations. So what could be null explanations here? Well, so if the winter is unusually cold, I would assume natural gas prices go up, all right? And this should be pretty easy to establish, right? There could be some regression there to check on this. And if I'm right, if natural gas prices go up, yes, you have more revenue, but also your costs are higher, right? And so then it's not so surprising that net income is not budging much, all right? Or at least, you could establish the extent to which this is true and whether there's earnings management beyond that. And also when, say, summer is unusually hot, maybe, the way utilities operate, they have to have spare capacity, but these are usually the higher marginal cost plants. And if you bring this online, basically, yes, you have more revenue, but you have more costs. These are the higher costs, actually. So net income is less affected. So I would say that these can be investigated, and this will help. And at least to me, this looks doable. It may become more complicated in practice. I don't know. And the second thing is maybe really this is the focus here. In the authors, I think, need to strengthen the earnings management explanation, basically looking at specific things which will make this work, where the revenue is sensitive but net income is not. Because right now it's sort of a black box, right? Something happens between revenue and EBITDA, but what exactly is that? So what could that be? I think, again, the focus settings here allows you to look at things like the provision for environmental remediation. This is a big accrual, I assume, for utility firms. And it's an accrual which allows you a lot of freedom, right? Because you're estimating things in 10, 20, 30 years. Who knows what that is? You can change it almost at will. It's an obscure item. It's not a line item on the income statement. But if you look at the footnotes, actually, you could figure this out. All right. So it will be a nice contribution if you actually figure out something from this item or items along these lines. Basically, other reserve, maybe look at accrual reversals. I would also recommend looking at actual fiscal years versus synthetic fiscal years. So if you look at EPS from actual fiscal years versus synthetic, here is, let's say, the last quarter from previous years, first 3 quarters from this year. Okay, so this is not an actual reporting period. So what would I expect here? Well, revenue is still sensitive, has to be to weather. And I would say if the story of the authors is true, earnings here will be sensitive as well in this synthetic period, but not in the actual. If this works, I think this will be a nice way to buttress the analysis. For detail, look at that paper, Jacob and Jorgensen. I think they do this, and this could be a nice test to do here. Broadly speaking, this is the single most important thing to do, I think, in a paper to basically clinch the case of earnings management. It's a little too circumstantial for my taste. The charitable giving portion of the paper is very nice. The charitable giving item is great because first, it's very discretionary in both timing and magnitude. So it's a perfect item to investigate, right? When I'm worried about the null, well, this is not like the other type of costs which are affected by revenue or affect future revenue investments and so on. This is very discretionary. It's almost completely separable from operations. So it's the ideal item in some sense. So I really like that. My take on the findings, though, is that the charitable giving effect is rather small. So if you remember, 1 quartile increase in weather increased revenue by 6%. So it's about $400 million. And if you do the math, charitable spending is increased by also $6 million for 1 quartile increase in weather. And so the numbers are just too small for the effect. So we could say that charitable giving is suggestive of the effect, but it's not being the effect, or it's a small part of being the effect, 1 or 2%. And the second main thing here is that there's some problems of interpretation, of course. If we have more money and donate more money, that's certainly very plausible, but is this earnings management? I mean, that's what a lot of us do, right? When you have more money, you give more money for charitable purposes. And so there is, again, we're back to this problem of interpretation. What does this actually mean? A few comments in no particular order beyond these main findings. So a defining feature of the study, as I said, is a small sample size. We know the usual disadvantage of that, the statistical power, generalizability, and so on. But I think there's a strong pros as well. This focus setting allows you to do things which you couldn't do otherwise. And I think that's a big part of the value of the paper. And also small sample size, but if you get significant result, this means that these effects were economically significant. So I don't need 10,000 observations to get statistical significance. So again, that's positive for the paper. For the no control variables, yes, a lot of things are randomized, but say what I was talking about, the gas price, that should be there, maybe at least worth thinking about it. Maybe at least just a discussion about it, maybe that would do it. I would have been curious how does this look on the ground level when you talk to utility executives, when they don't give you the donuts, the good donuts, what would be their reaction? I think it would be just nice to hear. And finally, almost out of time. So summaries, the focus setting allows a better understanding control fundamentals. I think that's one way to move forward the literature. So I enjoy seeing that. The basic story setup have considerable intuitive appeal. That's a very strong point of the study. My take on it is I don't have much quibbling with the way the study is done, the methodology or the results themselves. But I think interpretation, conclusions, I think reasonable people can differ there more. So my single biggest recommendation: disprove null explanations and try to strengthen the earnings management explanations. Thank you.
Fantastic. Thank you very much, Ilia, and under time, so really appreciate that. Thank you for the comments. And, I can like to give Charlie just a minute or two if you'd like to respond, or we can just move directly to questions.
Yeah, give you 1 minute. First of all, thank you. Those were really useful comments. When you actually look at CompuStat, and this is we're going to show we're not accounting folks, there's very little of the sub items on there for these utilities. And so your idea of maybe getting some of that data, I think is a great, looking at some footnotes because it's a small sample, so we can look up some of that, is something that we should definitely do. That's a great suggestion. The actual versus synthetic fiscal year is great. Thinking a little bit about marginal costs. I mean, the fixed costs are high, but marginal costs could go the other way. And so if we could get some information on that, that would be useful. I don't think it'll change the result, but that's certainly something worth looking into. The one thing on the magnitudes, obviously, it's a difference of percentage versus dollars, meaning they're percentage-wise changing their charitable spending a lot, but they're not spending that much in charitable spending, at least in these sources that we track. So part of it depends on whether you think that this is sort of scales with a lot of other similar items that are hard to see. My donut that I didn't get, the employee training, executive ed. You talk to executive ed folks and they're aware of this sort of thing. But we might be able to do something on that, at least to calibrate it with some other things. We had thought about advertising. There's some interesting accounting work on advertising, but the utilities don't really advertise that much. So we'll have to think, but those are all great suggestions. In particular, we'll dig in and really figure out the fixed cost, marginal cost thing, and we'll push harder. Great suggestions. Really appreciate them. Thank you. I'm glad I passed through an accounting discussion. I was a little nervous. Okay.
Okay, well, so, all right, great. So what I'm going to do is read through a few questions here. So some of these questions are going to reflect some of the comments that Ilia brought up and actually dive a little bit deeper into them. So there are a number of questions from Saurabh at SMU, Matt at Wharton, Itai at Ross, Beth Explorer, Beth at U of at Washington, UW, and Deborah at Xavier about really digging into, is this earnings management? And I'm going to highlight a specific comment from Eva at Ohio State, who talks about, like, a lot of these cross-sectional tests in your paper are relying on the typical incentives in real earnings management, which is kind of this idea of deceiving investors. But it doesn't necessarily seem like that's a fruitful path in this setting. Utilities might be smoothing earnings to avoid regulatory scrutiny or other types of intervention around raising or changing prices. And so smoothing in this setting actually could be aligned with the interest of shareholders. And related to that, there are also just one other comment related to this, idea that in this setting, earnings management might be aligned with the interest of shareholders. Is that, for example, what if they're giving to green energy companies? This is a comment brought up by Bryce. This green energy companies who are giving, they're giving to these, not-for-profit or other types of enterprises who might be aligned with their incentives of trying to improve profitability through other channels in the long run. So how do you think about this trade-off of, like, in this setting, that earnings management may actually be something that is aligned with shareholders? And if that's so, would you still consider that a form of earnings management in your mind?
Yeah, so those are great questions. And again, I'm still learning what earnings management means, but or we are as a team. So let me first go to the thing about wanting to smooth your earnings because you're worried about regulators not seeing windfalls and that sort of thing. So it turns out that these firms actually have a separate set of regulatory books that they manage that are used for sort of rate of return regulation, et cetera. And so there is some ability to this earnings per share number or earnings number they're reporting to Wall Street is not the same thing they're reporting to regulators. They have so they're sort of talking to two audiences, and I guess we can look at how this is treated in sort of their regulatory books. I do know that, I know one firm, absolutely does this for earnings management, and we're seeing this pattern then in the whole sample. In terms of investing in green energy, and now, we're agnostic on whether charitable giving is good or not. There's a big finance debate on that. There's a positive and a negative. It costs money. A lot of the reason why utilities give a lot is they're trying to butter up regulators. They're trying to look green, whether or not they want to be green. The real question is whether the optimal path of the amount that you should give should depend on whether you got killed in the fourth quarter because of the weather not going with you or going with you, and smoothing that out. And so I think that any story about sort of the optimal dynamic spending on charity would very unlikely to be generating the kind of variation we're getting in terms of the actual observed path. Okay, but I have to think a lot harder. That's a very good point about trying to smooth so that regulators never see you sort of making a windfall. I can just tell you that this firm was just very proud of the fact that they always got a 7%. I was horrified, but they always get a 7% earnings growth. And they said, that's what they told Wall Street. That's what Wall Street wants. That's what they'll give Wall Street. And so they're clearly doing it for earnings management, Wall Street concerns and not regulatory concerns. But I'll have to think a little bit about the regulatory dimension and how they do those books, because it is a separate set of books. I got to learn some more accounting then. Okay, thanks.
Yeah, great. I actually have to say that phrase sounds very familiar. I think I read it in a book about Enron, about constant and consistent earnings. So you're kind of diving into this, you're referring to the seasonality and the fourth quarter versus the other quarter results that you had. So we had three comments come in, Sudipto at Temple, Lorian at USC, and Christy at Iowa, thinking about that seasonality. And I think one was a potential other explanation. Another one is thinking about this in terms of some heterogeneity that you could exploit in your tests. So the first comment is thinking about, potentially, is there greater demand for relief, like some type of charitable relief, when energy demand is high? So for example, heat waves in the summer, polar vortex in the winter, when people are suffering more. And a comment was that the preliminary fourth quarter results also seem consistent with people being more sensitive to charitable needs around the holiday season. So, thinking about that there's potentially maybe some explanation for why you see additional spending in that time. And then a comment specifically about differentiating actually the types of electricity. So, thinking about in the summer, which might be more electricity driven and rarely free, for example, in the Midwest, with heat that is mostly gas and often is provided, I think the comment was charitably. So I'm not as familiar with the nuances here, but exploiting some heterogeneity, both in terms of the timing and type of electricity that's provided, and thinking about that in terms of the need of the recipients.
Yeah, so those are great comments. We tried a little bit because some of these are classified as electric utilities, some are electric and gas. There's none that are pure gas. And we did try separating, as Ilia sort of pointed out, the pro and the con of the study is the sample's not that big. So when we try to look at sort of variation within the sample, we don't, the samples get very small. I have to think a little bit more about the holiday season thing and people just being more charitable. I mean, sometimes they're also more Scroogey, though. That's sort of the point, is that they're more willing to be Scroogey or charitable depending on the weather. Unfortunately, all these firms have December fiscal year ending, so we can't exploit that. The one thing I'm thinking we might be able to do is that the evidence that we report on that Ilia was talking about sort of the overall income statement items, those we can do on a bigger sample, because those we don't need the charitable data. The charitable data cuts down our sample size in a major way. So we might be able to do a little bit more on the cross-sectional variation We did look at we thought about southern versus northern utilities. Southern utilities are mostly cooling demand in the summer, and that's more in the middle of the year before the fiscal year ends. It turns out though there's also less actual variation there. And so we might be able to do something with some more cross-sectional variation. The other thing I thought of a little bit in getting ready today was a lot of folks have looked at sort of career concerns of CEOs and how much they manage earnings based on sort of career ending sort of stuff. And so we might think about that. So that's, those are all good suggestions. We have to process, and I think we can do something on some of those. Thank you.
Super. Okay, so I think we have time for a couple more questions here. So highlighting a question from Anya at the Fed, thinking about the role of regulation a bit more. So you talked about this other set of books, but obviously regulators, for firms that are public can observe the public financial statements.
Right.
And so, can you think a little bit more about like this net income result being explained really by the fact that utilities are price regulated in the US and many states allow utilities to adjust the rates. So is charitable giving something that utilities do to really kind of cater to these regulators? Or is it given, almost to improve the reputation in the community? So consistent with this other thought of, the community may not love to see that utilities are just doing really well, frankly, at their expense. And so is this a way to help manage that reputational concern by the company?
Right. Okay. So those are great. I think definitely they're giving a lot to charity. Utilities are some of the biggest corporate givers, specifically because they are trying to butter up the regulators. The real question is, do they need to give more when the weather is harsher in some sense? And so maybe that's going to be, maybe we can get something on sort of extreme weather events. Maybe there's some nonlinearity we could try to exploit because it's not clear whether it's, just 10% colder that people are aware enough that that you have got to give 3 times as much as you usually do. And so but if it's a really, really cold winter, you might want to say you gave a lot. And this is not just sort of giving away free electricity. This is actually cash donations. So I have to think a little bit about that. But the other thing is we actually have separated the sample there's something called decoupling. In some states, essentially when you get a windfall because of the weather, the rates automatically somewhat adjust. And so we thought that then we might see differences in those states, less sensitivity because it's automatically built in sort of smoothing of earnings because you don't get these windfalls. We didn't see a difference there. And of course, our sales item, the top line already reflects sort of any automatic changing in the rate of return regulation. And so we've tried our best to think about sort of the regulatory structure, and we don't see any differences based on states that sort of are more quick to sort of take away any windfalls or give you back when weather demand sort of goes against you. But we could probably do a little bit more on that. So those are good suggestions. A lot of good things to think about.
Great. And I think, so I'm going to close with one final question that came in from Beth from UW. Is related to the outcomes and the implications of this. And so, and I don't think that your paper is going there yet. I'm not sure that it will, but if in fact that the charitable giving is highly fluctuating based on weather, like what is the implication or welfare concern of that? So if this, these firms are giving and that giving is just going to vary randomly with weather, then what is the implication to, not only those organizations, but also the individuals that benefit from the mission and from the work that those organizations do?
Yeah, that's a big picture question. Again, we don't really know whether this giving is sort of good or bad from the firm's even perspective. There's this debate about whether it's an agency problem, they overgive or undergive. And then of course it could affect people. I mean, people United Way one year in Michigan got a very small donation or nothing because the utility couldn't make its numbers. Just in terms of shareholder value maximization, though, we know the ability to hedge weather risk for very financially well-heeled utilities raises their value. So it does suggest that these types of activities, if they have other ways to smooth things, not doing this sort of very, very non-smooth path of spending, that's anecdotally consistent with this at least being good for shareholders. But that's just speculation, and the bigger welfare consequences, that's deep thinking. So we'll maybe speculate a little bit more, but it might be hard to say anything more than that. Thank you.